Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. And we've got a beautiful morning here in Vancouver. Wonderful. And we even have a little sunshine in the stock market today.
And before we start chatting about how maybe the markets bounce back a bit, we like to go to listener questions. This one comes from Michael. Hi, Jim and Bob. Bob, is this a good time to short the market in the intermediate term? I understand lower prices are likely over the longer term, but will we have the rip-roaring bear market rally that historically accompanies bear markets? I thought that would have occurred after that May 12 low, but all we got was a small bounce followed by a lower low. Are those bullish animal spirits gone forever? Also, it looks like the U.S. dollar double top this year. Is the USD rally over?
Yeah, Michael, good coverage on the markets. Yeah, and hey, the key thing in May was that, a few weeks ago, was that you had an oversold in May, and it went kind of up a little, and then it undercut the previous lows. But now it looks like, I don't know, this could last a few weeks, but Jim, it gives me a chance to put in my very bold forecast, is that we will have a typical summer. And I rest this upon that the journalists, the financial markets, if there is a rally in the summer, they call it a typical summer rally. And if it's going down, it will be the typical summer doldrums. So at the moment, we have a typical summer rally. And I'm quite sure there will be some doldrums. But basically, Michael, there's a lot of damage done to the financial markets. And you're right to look for opportunities to short on the rallies, but I wouldn't do any counter trends like buy a dip hoping to get out. That's dangerous. But finding the highs on rallies and shorting them or selling them is appropriate. And now, what was the last one? Oh, the animal spirits. Gosh, they've been damaged a lot. That was a Keynesian term to where he was trying to explain the markets, but no, it looks like the huge bubble climaxed in January. We had all kinds of overboughts at that time, and also there's been a tendency for major market actions to complete in January. The Nikkei in last trading day in 1989. The huge gold and silver speculation, I think it was January 22nd, 1980. And then there was a very important bull and bear market. The S&P peaked, I think, January 10th or 11th of 1973, and then went into the worst bear market since the 1930s. So that seemed to set the top. And the deterioration in market breadth, the widening of credit spreads, and then you also had the yield curve inverting, which on our charts back to 1857, the main conclusion is that if the yield curve inverts, which means that short rates get higher than long rates, a recession follows. It's the rule, so to speak. So now, on the U.S. dollar, oh my gosh, the rush on the distress in March, April, and May was, well, it drove the DX up to 105. Earlier in the year, we had a target of 103. So, hey, but with that, there was terrific technical excesses, and we called for the correction, and the exact high was 105. And then it went down to, 101.5 or something like that. And then it's been around 104. My guess is that it could stay near this 104 level, let's say 103, 104, or through to August. And then we know that often a credit problem can be discovered in the fall of the year, and in which case the old rule comes in, and that is the senior currency goes up in the midst of a financial crisis. So, no, this is just a pause, a rest for the U.S. dollar, and higher prices are quite likely after August. Thanks for the question.
And Bob, second question that just came in from Andrew in Edmonton. Hi, Jim and Bob. I listen to you every week with interest, especially with respect to the markets. What is Bob's view on both the GDX, the GDXJ, in terms of performance for the remainder of the year? That would be the gold market.
Oh, yeah. Good timing on this one. The gold sector, and particularly on small cap, junior, exploration type stocks, has been devastating. It's just one of the worst, as I recall, since the early 70s. And it's a sector that I kind of like and will trade from time to time. But here we'll back up on the gold sector, where in July 2020, the gold sector became extremely overbought, which we advised, and we suggested our readers that both investors and traders should take a lot of money off the table because it was pretty hot stuff. And also what happens is that gold's real price heads down as a great financial bubble completes, which we got. So, and then that also, with a weak real price for gold, it's not good for the stock prices. And so typically as a bubble concludes, the gold stocks go down or underperform. And then the problem is, if that's not bad enough, you get a year or so of poor performance while all other stock sectors are going up. Then when the big market breaks, it takes the gold stocks down with it, which has happened. And I really like the long term for the gold sector, because once a bubble is over, gold's real price goes up. That's because gold holds its value, and most commodities and wages and everything else fall relative to gold, so that it improves the profit margins for gold miners. And also it improves valuations for, explorers with a gold prospect. So this is very strange for those who haven't done research. But at any rate, the latest downtick in the real price is setting a base for a major advance. And also, last week we got the idea of taking gold and dividing it by the CRB commodity index, and it is really oversold. So it could lead, because you see the real price of gold depends on each monthly release of the CPI number. So this is virtually daily on the CRB. So now it is extremely oversold. And a number of junior mining stocks I know of have been absolutely devastated. It's incredible. So I know one of guys I know have been involved in the deal, Discovery in Australia. Stock in 2017 rallied from 70 cents in the spring to 8.75, I think, in that September, and then now it's down to 60 cents. I mean, and what has happened is that many of these junior exploration stocks have been hit the same way, and it's perhaps the worst I've seen since the early 1970s. So with what we've got on our historical stuff, once this gold market has bottomed, it will be followed by a multi-year bull market. So you want to be in the play, and not just a multi-year bull market for gold stocks. Quite likely, your gold indexes like GDX or GDXJ will outperform the Standard & Poor's index. And if you get a few quarters of that happening with the gold stocks outperforming the S&P, that many fund managers out there, many equity fund managers out there that would normally not position gold stocks, they're going to take a look at that outperformance and they're going to have to buy it as well. So, hey, the prospect for gold is very good. It could be bottoming, and it could take many, many weeks here yet. And the buy is going to be very difficult, and that's what it always is at a washed out and completely devastated bottom, which is where we are now. So we'll watch it very closely, and I'm quite sure we'll be able to come up with the buy as it occurs. Thanks very much for your question.
And he also had a comment about Bob always says the South Sea bubble was the first bubble. What about tulip mania in the early 1600s?
Yeah, that's always a fascinating market phenomenon, but it occurred at a depression bottom where you had some liquidity around and some unprofessionals, not commercial traders, suddenly started buying tulip bulbs, and they were making markets. They had chalkboards in taverns to keep track of the price. The authorities, now this is when Holland was the 16th century. That was when Amsterdam was the financial capital of the world. So Holland was the commercial and financial center of the world. And so there were very good markets and authorities on it. And the authorities warned these speculators in tulips that, hey, there's no way of guaranteeing clearing the market, the contracts and everything else, and just avoid it. And it turned out to be a disaster. So it was an oddity, and it was like in London, it wasn't until the 1670s where you had enough publicly traded stocks to call it a stock market. Then so by 1680, you could call it a stock market. In 1692, the first stock market letter in London was published by a guy by the name of Houghton, John Houghton, I think it was, and it was a market letter. So that was the modern world arrived, and then the other step towards the modern finance was the formation of the Bank of England in 1694. So then that set up a viable stock market, and the first great financial bubble was the South Sea bubble, and it included all kinds of stocks, new issues, and everybody on board, the government sponsorship, everything. So to put it in perspective, the tulips was an oddity. The South Sea bubble set the pattern for all 5 subsequent great financial bubbles, including the one that has completed here recently. So a good question. Thanks a lot.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines that caught your eye today. Biden looks everywhere to lower gas prices except boosting oil production.
Yeah, I think many people can take a look at that and say, what in the hell is going on? But you've got radical people in the White House and in the Democrat Congress, and they have this mania that somehow carbon dioxide is causing global warming, which me as a geophysicist knows is absolute nonsense. So then they had to shut down the oil and gas business. And even a month ago, Biden was saying, oh, the high gas prices is good because it's on the way to forcing people to buy electric cars, which are very expensive. So it's been deliberate policy. But then when the Democrats get the heat from people complaining about high gasoline prices, who the hell do they go to? Well, they go to dictatorships in Iran and Venezuela and plead for them to increase production. And they're really not biting back too hard on Russian production. So the high price in energies is hinges upon the Biden decision to wherever they could to shut down oil and gas, discovery, exploration, development, refining, transportation with pipelines. They want to shut it all down. So then they get the heat. The high price is helping Biden's invasion of Ukraine, and the Americans are spending all kinds of money to Ukraine to defend their border, while the Biden administration opens the Mexican border. I mean, you just got to list these things, and they're absolutely paradoxical, just totally contrasting, totally insane. So what's going to happen with the gasoline prices? Well, the rise in prices became overbought, and a correction has started, and so we'll see what happens. Also, following a great financial bubble, when it shuts down, the economy heads south with it as well. So many of these elevated commodity prices could be heading seriously south after August. So, anyways, the insanity of the active left today is, you can't imagine this. You could not invent this, say, 50 years ago.
Another headline that caught your eye, UN chief warns of catastrophe from global food shortages.
Yep, there we are, catastrophe. Yeah, we've been bullish on agricultural prices for a few years, one on the chart, and the other is that since the high for global temperatures in 2016 with that El Nino, there's been a fair amount of cooling, so that the growing season in North America and the Northern Hemisphere has been shortening, later frost and earlier frost, that kind of thing. So that's been a positive for the grains. And then, of course, you had the exceptional event of Putin invading Ukraine and not just messing up their economy and their important agricultural production, but also blockading it in. But I think the Brits are sending some ships in to kind of try and open sea lanes, and maybe they can get some out. But at any rate, we just did a chart today showing that a number of these hot commodities, including some of the grains, reached technical excesses and seem to be rolling over. So the catastrophe warning seems a little late, and the market is showing deterioration in price.
Another headline, an oil expert says gasoline prices could reach apocalyptic numbers.
Oh, yeah, I like that one. We've got catastrophe. We've got apocalyptic. Hey, it's just right off the wall. But again, as I just said, some of the key commodities reached upside exhaustion, is our technical word, and actually have been rolling over. So we're now looking for important lows Often copper is really broken down. Copper can have a seasonal low in November, lumber can have a seasonal low in October, and crude oil often can have a seasonal low in January, February kind of thing. So I would think the direction for most commodities is going to be down until late in the year or January or something like that. So, but I love these apocalyptic forecasts on commodities and catastrophic forecasts on gasoline. Wonderful stuff, but it's you never find statements like that at the bottom of a market, only at tops. So, yeah, it's been fascinating, Jim.
Bob, thank you so much for chatting with us.
Good to be with you, Jim, and look forward to getting together next Friday.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.